All right. Today is Sunday, June 25th. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Let's begin with this. At the end of any hype, claims get outrageous. And right now, what we see in this hype, in this bubble that we have in 23, of course, this is the best performance in the NASDAQ 100 since 1999. I wonder what happened back then. But anyways, at the end of the hype, or perhaps what brings the end of any hype, we can look at it both ways, is outrageous claims. They get out of whack and it becomes impossible to live to. Read this headline, for example. It says Tesla's valuation could soar by another $150 billion thanks to the rise of the robo-taxi, which is, by the way, the same recycled story since 2018. And by the way, where are the robo-taxis? I'm still waiting though. Here's another one. Apple stock could soar 37% to a $4 trillion market valuation by the end of 24 after confirming a key breakout to all-time highs. And who's going to buy all of these iPhones that the stock price is pricing in right now? Because China's not doing so good. The U.S. consumer is about to pay student loans again for the first time in 3 years. They're running out of savings. They're maxing out the credit cards. Who's going to buy the iPhones? I guess AI, right? AI is going to buy everything. Here's another headline. It says, AI fever will carry the bull market higher, even as the U.S. economy tips into a recession. A veteran trader says, even if we have a nuclear war, the end of the planet, doesn't matter. The NASDAQ's still going to go higher because of the AI fever. Here's another one. It says the stock market is presenting investors with another buy-the-dip opportunity as sidelined cash piles up and the economy continues to expand. And this is according to Fraudstart. Here's the Treasury Secretary, Elon, and she says that she sees lower U.S. recession risk and says that consumer slowdown is needed. By the way, same lady who said that inflation is transitory. So there you go. Recession? What recession? Consumer who gives a shit. AI is going to fix it all. And of course, there is a reason behind all of this pumping. It's called a pump and dump scheme. Pump, so you can have the public, the common folk, getting excited that they bought a lotto ticket and they're going to win big. Everybody's going to win the jackpot. And of course, these hypers who are selling the lotto ticket, what do? They cash out because they don't really believe in this bullshit. They're just selling it to us, the dummies, the village people. Are we going to chase and then we're going to end up holding the bag while they cash out? But I know this time it's different, right? Because the oligarchs, they have your best interest in mind this time around. Take, for example, the ticker Space. Remember that one? With Shamath Skamapapapia? Well, they pumped, of course, because they have something new. And then as the retail mom and pops stampeded to buy the stock because, wow, look, they're going to go to space now. The company dumps right away, raising $300 to $400 million. Thank you so much for your service. And of course, you have the experts on CNBC who, of course, have your best interest in mind. It's not like their job basically to sell the latest scam by the oligarchy. No. CNBC would never do that. They just want to inform you about stuff. And when NVIDIA popped higher, remember that one, the big one? The $11 billion of revenue that remains unexplained? Here's Jason Snipe from Odyssey Capital. He says, hold it, own it, let it ride, baby. Let it ride. Let it ride. Don't touch it. And fast forward to this Friday, and here it is.
We're going to have much more on that coming up. But first, we've got a trade alert for you. We got our Jason Snipe trimming his position in NVIDIA and Palo Alto. Jason, explain this one to us. A lot of people are trying to ride that AI wave. You're actually jumping ship a bit.
So what happened to let it ride? Hold it. Don't touch it. All of a sudden, no, touch it. Take your profit. But you only got that information after you got sucked in and you bought. Now they dump in your head. Same old game. Never changes. But my favorite, of course, is from Oracle CEO Larry Ellison, who's been pumping AI. I think he said AI 50 times, and the stock shot up higher. So what did Larry Ellison do? He cashed out, of course. Over $600 million worth of stock. Now, this oligarch is really big. Like, he owns everything. Jets, airplanes, yachts, private islands, human beings, everything. But all of a sudden, Larry Ellison is dumping his homes. He's dumping a lot of stock. What does he need the money for? What is he going to spend all of this money on? I have no idea, but I always admired Larry. He's my favorite oligarch. Always has beautiful women around. And he likes them really young. not really Epsteinish, but the safe zone. Like, okay, bro, she's 19, but kind of creepy, sure. We're not breaking any laws or anything here. DiCaprio sells his covered calls at 25. Larry Ellison sells his covered calls at 20 and a half. Max. And of course, a lot of oligarchs have their reasons why they're into young people, but Larry believes in longevity. He believes that you can actually live forever. You can expand your life. And the secret, of course, is to get in touch with younger folk. The closer, the better, because there is an exchange of energy and all of that, and that makes you younger. I don't know if that works or not, but the guy is almost 80 and he looks pretty good. So maybe there is something into it. I don't know. But the point being here is, see, everybody says the economy is rigged. It's not really rigged. It's just because we have a lot of dumb people in the economy. And the secret to becoming rich in America is not to work hard. That's just part of the propaganda that we do to get immigrants here so we can lock them in horrific jobs. We get to overwork them and underpay them, right? But if you want to be rich in this country, you got to figure out a new scam. Of course, we're not going to call it that. It's an entity. It's a promise. It's a hype. It's the future, bro. It's the future of commerce. It's the future of business. And you don't want to miss out. It's the next.com. It's the next AI, so on and so forth. And then you sit in your ass and you watch the public work hard, and then they come out and they hand all of that money to you, buying the promise that they will be rich later on, because this is the next fill in the blank. And as the value of the entity that you're selling them goes higher and higher and higher, you hit the cha-ching button, and all of a sudden that fake money, the paper money, becomes real because the wealth has been transferred. Somebody bought, you hit the cha-ching, you get their money, they're not going to get it back. It's a zero-sum game. So is the economy really rigged? Maybe. Quantitative easing, sure. But at the end of the day, this massive wealth gap happens because we have a lot of dumb people in the economy who transfer their wealth every single time and every single hype. And the oligarchs walk away winners. But anyhow, with this lovely explanation of our economy, let's move on and talk about markets a little bit. And the talk of the town is the rotation, or perhaps lack thereof. You see, by now, everybody's aware that this rally that we've seen in the stock market is led by 7 names. That's it. 7 names in the S&P 500. And the rest are either flattish or down. These 7 names happen to be in technology, communication services. Thank you to Google. Thank you to Meta. And of course, consumer discretionary. Thank you, Amazon. Thank you, Tesla. So we see technology up 38% year to date, communication services up 35%, consumer discretionary up 29% year to date. And then you got industrials a little bit, about 5%. Thank you to the false optimism of China reopening, which is fading away, by the way. Then we got metals up a little bit, but the rest are down, or flattish at best. And of course, the criticism from the bears who don't like this rally is it's really narrow, which probably means it's a bubble. It's not really a bull market or any sustainable rally. But recently, we have seen these kind of names, be it banks, be it small caps, be it industrials, be it metals, be it even at certain days oil, were moving higher. And the bulls looked at the bears and said, what you got to say now? It's looking better. We're seeing a rotation. We're seeing all of these cyclical sectors also catching a bid. It's not just an AI bubble. This could be the real deal. The problem is, if we look at the action that we got this week, did we see a yield-led rotation to high dividend names, healthcare, real estate, utilities? The answer is not really. Yields went higher. Sure, healthcare was the outperformer for the week, but it was negative. Did we see a dollar-led rotation to Chinese names or consumer staples or commodities, energy, industrials, metals? For one day this week, sure. But then you look at the Chinese market, it's down big for the week. Commodities down, energy down, industrials down, metals down. So we don't have a rotation here. Then we look at the soft landing rotation, consumer cyclicals, IWM, regional banks, retail, not really, no rotation. The IWM was the underperformer this week, down a little over 3.5%. You look at the XRT, for example, retail, down about 3%. So there is no rotation. The only rotation we got this week is to the dumpster. And why is that so important, Maverick? Why can't we just have a bull market based on 7 names? Who cares? I mean, who really cares about any of these boomer sectors of the stock market? Just stick to the 7 names. Here's why it's important. It validates whether we have a bubble or an actual bull market. Let's go back to the .com bubble. In white, the NASDAQ, the NDX. In orange, the SPX, the S&P 500, which was not heavy by the big cap technology names. This is back 20 years ago, more than 20 years ago. 98 is when the mania began, and it went all the way to 2000. In the course of those years, the Nasdaq was up a little over 300%. The S&P was up about 60%. So clearly, the rally, the majority of the bubble was concentrated in the dot-com names, in the technology names. We did not see the cyclical names, the Buffett kind of names, also rallying significantly higher and joining the Nasdaq names. And that's how we knew it's a concentrated bubble. The problem is when it pops, it takes everything down with it. Peak of the dot-com bubble, all the way down to the bottom, October 2002. The Nasdaq went down by about 80%. The S&P also went down by about 40%. That's the problem when you have a concentrated bubble. It blows up, it takes everything down with it. Then you have a legitimate rotation that we've seen back in 2020. In white, the Qs. In orange, this time around, the IWM, the Russell 2000. Now, as you can see in the summer of 2020, Nasdaq names outperformed the IWM by a lot. Matter of fact, the IWM was negative, while the Qs was rallying higher. The stay-at-home mania, the stock split mania. But nobody wanted to buy the cyclical names, the reopening names in the IWM. But then we saw the Qs cooling down and the IWM catching a bit, as you can see, and it closed the gap in performance. So there was a legitimate rotation, and 2021 was a bull market. Now, when we look at it from a price perspective alone, you can see clearly that the IWM did outperform the Qs in the first half of 2021, hence confirming it is a bull market. If we don't get this, if we don't have a rotation, then you have all of these managers cashing out, booking gains, because they're not stupid. When they see the RSIs way too elevated, when they see the retail mania jumping in, they tend to cash out. And now the question becomes, where will the cash go? If it goes to the IWM, the cyclical side of the economy, any kind of rotation, then the stock market will hold and we will see a bull rally continuing and going on. Specifically in the S&P this time around, not the Qs. But if they rotate to cash, or if they rotate to bonds, or any financial instrument, besides the equities market, then the market is not going to hold. It's going to be exposed as a bubble, and it's going to go down because retail buying alone is not going to do it if the big money is not going to join and rotate to other sides of the market. And this brings us to the structure of the stock market right now. And this is really important. We talked about how the market was mechanical in nature in the last few weeks, and we were anticipating a shift from mechanical market to a technical market, where stock market technicals on the chart become the main driver of the action. Now, a few important things that you should know about mechanical markets. They're usually dominated by options activities. We see gamma squeezes, reverse gamma squeezes. They're also accompanied by extreme sentiment indicators. We see either extreme bullishness or extreme bearishness. They often push the boundaries of technical limitations. So if you thought the RSI is overbought, it keeps getting overbought. If you thought it's oversold, it keeps going down. And it becomes really frustrating. We also see increasing volume in mechanical markets. We see extreme moves in the VIX. In the case of a mechanical market that is selling off, we see the VIX exploding higher. In the case of a mechanical market that is supporting a mania, we see the VIX getting crushed, as we see right now. Usually, mechanical markets end in climax. Huge moves that tend to end suddenly, sometimes intraday, and they're followed by sharp reversals. Now, think about the market like this. We have three things that move markets: fundamentals, technicals, and mechanics. And of course, the pure technicians would look at this and say, that's a joke. You don't need to look at the fundamentals. Just look at the charts. That's fun and games because the majority of the time, the market is technical. When we don't have any news, any changes, any increases in volume, the market usually follows a predictable technical pattern. The algorithms follow the charts. Simple as that. But once we shift into a mechanical market with extreme moves, or a fundamental market, such as Brexit, for example, such as 2016, such as 2022, all of a sudden those technicians, they start speaking with both sides of the mouth. Oh, the market could do this, could do that. Watch the number here, the number that. But they cannot really explain what's going on. So anybody who tells you, oh, the stock market is all about charts, it's bullshit. We have fundamental markets, we have technical markets, we have mechanical markets. If we start from the neutral zone, usually in, let's say, a bull market, a regular, plain vanilla bull market, mostly they're technical in nature, and what we see is the technical slider moving all the way to becoming extremely bullish. So we see overbought readings in the charts, and then we see pullbacks, aka dips. They take the technicals to cool down, and then these dips are bought, lather, rinse, repeat. This is how bull markets work. But this is what we look like right now. It is a mechanical market dominated by the mechanics, which happen to be at the extreme or max bullish levels right now. How do we know that? We have extremely high number of call options versus put options being bought. We see the gamma squeezes. We look at the technicals. We see the RSIs defying boundaries, becoming really extreme. Look at Tesla, for example. And the thing is, when we see technical rallies concluded by a mechanical market and a mechanical move, usually we don't get a plain vanilla pullback, or let's say the RSIs go back to neutral. No, in these kind of runs that are concluded by a mechanical market, the reversion in technicals goes all the way back to become extremely bearish. We see oversold RSIs and then recovering back to neutral as the mechanics move back from extremely bullish, max bullish, to neutral, because you think about mechanics as sort of an amplifier of technical moves. The problem is when we see technicals moving back from overbought to oversold because it was concluded by a mechanical move, yet the mechanics don't stop back at neutral. They slide all the way back to become extremely bearish all of a sudden, producing phenomenons such as Volmageddon.
This is an ABC News special report. Now reporting, George Stephanopoulos.
Good afternoon. We're coming on the air now with news from Wall Street. Want to take you to the floor of the stock exchange. There you see the Dow down more than 1,000 points right now, coming on top of a more than 600-point loss on Friday. That puts the Dow in negative territory for this year, down a little more than 4%.
Breaking news, President Trump refusing to answer questions about the historic plunge in the market today.
President Trump, anything on the stock market? Any comment on the Dow?
Well, that's because the Dow plunged 1,175 points today. At one point, it was down nearly 1,600 points. And no matter which way you look at it, the nadir or the close, it was the biggest drop in history for intraday and close.
And here's 2018 Volmageddon. The mechanical move pushed the market by about 7.5%. Absolute insanity. We got the climax, and the reversal was supposed to be amicable. The technicals were extreme, and the expectations were they move back to neutral, and we get a pullback, and that's it. But then there are mechanical elements that slid too fast from becoming max bullish to becoming max bearish in a short amount of time, in a lightning speed kind of move. And the stock market collapsed by about 11.5%. Well, how did that happen? Why did we see Volmageddon? Why did we see such an exaggerated move? The answer is the mechanical element. It slid way too fast from max bullish to max bearish, not to neutral. Why? Because we've seen a lot of games being played as this mechanical move was building on. Lots of shorting of the VIX, lots of playing around with these leverage products. You look at the SVXY, for example. Look at this. It collapsed like you have never seen before. This is Volmageddon right here. People were shorting the VIX. People were playing with these derivative products. And what do we see today? SVXY blasting higher, not as extreme as we've seen before. But you look at zero DTEs. You look at how heavily shorted the VIX is. You look at the extreme RSIs and the extreme euphoria that we're seeing right now. And we are prone to a Volmageddon-like move. Now, as we shift from a mechanical market to a technical market, you better hope that the mechanical elements of the market will go back to neutral amicably without sliding all the way back to becoming max bearish all of a sudden and producing a massive reverse gamma squeeze element. That's how Volmageddon happens. So when folks say, hey, Maverick, Volmageddon didn't happen last week, you're just doom and gloom, you're being too sensational. First of all, it's called YouTube. What the hell do you know about it? Second of all, we have the same conditions that led to Volmageddon. We have the same ingredients, maybe not as strong as we had them back in 18, but we have them here. So I'm explaining all of this to you just in case you wake up one morning with a big stick up your ass and you're wondering how that happened. This is how. Now, there is another important thing you have to understand. What if the market shifts to becoming fundamental all of a sudden? Because historically speaking, the shift to fundamentals from a mechanical market or a technical market usually happens suddenly. Something happens. A war breaks out. An accident happens. Somebody dies. Something blows up, aka Silicon Valley, and that could amplify the correction. So when we look at the market right now being too sanguine, specifically the participants, feeling so safe, This is exactly the kind of environment that we could see an accident happen. When we look at the fundamentals, we have to look at the wall of worry. Which one will flare up all of a sudden, and the market reverts from being a mechanical market or a technical market to becoming a fundamental market, which is, by the way, the best market mode for the bears, because the fundamentals are abysmal. When we look at the wall of worry, we have Washington, D.C., we have Russia, Ukraine, we have Europe, UK, we have China, we have the monetary policy and what comes with it, the banking crisis, etc. If we begin from Washington, D.C., what could go wrong all of a sudden? We continue to see what's going on with Biden, all the gaffes and the stumbling all over the place, not doing so hot so in the polls, and the question becomes, is he going to be the Democratic nominee? Time is running out. And if they decide to pull the plug on Biden, this is the kind of volatility that we've never seen before. Why would they pull the plug on a sitting president? Well, perhaps they don't want to lose. I mean, you look at the polls, and Joey B is doing abysmal when it comes to the economy. Americans have low confidence in the Biden economy. All voters, Democrats and Republicans, say that the economy is the number one issue. And Joe Biden does absolutely horrific when it comes to the economy. Even among Democrats, by the way. What is the Joey B administration response? How about more gaslighting and more propaganda? Now they got these trucks driving around saying, oh, Biden delivers again for the U.S. economy. Meanwhile, you look around and you see homeless people all over the place. That's the Biden economy. So this is not working anymore. Now all of a sudden next week, meaning this week, they have to drag Joey B all the way to Chicago so he can give an economic address. So CNBC, Fox, everybody's going to be wired the speech, and if he says something wrong, the Dow might go down by 1,000 points in a single day. Then, of course, you got this Hunter Biden thing. Who knows what's going to come out of that? Maybe it is a big one. Who knows? That's the unknown. And, of course, when we talk about policy, all eyes on student loans. We know that they have to pay it back now. We're going to resume student loan payments as soon as September. So all of that disposable income that used to go to the economy will now have to be rotated. That's the real rotation. It's going to be rotated all the way back to the banks. And they need that cash, desperately so. So who's going to spend to stimulate the economy? Because JP Morgan says that household excess savings will be gone by October. I'd say before that, with the student loans payment coming back, who will stimulate the economy? AI? So this is the kind of fundamental risk that we have when it comes to DC and the fiscal policy. And if the market decides to be wired to the fundamentals now, not the mechanics or the technicals, the market will suffer. Because if it looks at the fundamentals, in this case, student loan payments and the negative impact on the economy, and now you have all of these sky-high earnings expectations for companies, they're not going to be able to live to it. Who's going to buy all the iPhones when nobody has money to spend? And Apple is at all-time highs. And then we'll look at Russia, and this is flaring up as we talk right now. We all seen what happened over the weekend with the Wagner Group. That's the unknown. I mean, it's kind of known. We knew about it. We knew that he's going to go back and start some shit up with Putin. But this episode is not over yet. Who knows what's going to happen in the next few days in Russia? Most importantly, when it comes to the fundamental risk in Russia, Ukraine, we have to talk about the grain deal. This is the most important one from an economic perspective, at least. Now Ukraine says that 99.9% certain that Russia will quit the Black Sea grain deal in July. That's around the corner. If the market decides to look at this and sees more grain inflation, the reaction will be negative, and it will amplify the technical pullback. It could trigger the mechanicals slamming all the way back to bearish. Any of these fundamental risks on the wall of worry could do that. And of course, when we talk about Russia-Ukraine, we have the risk of a nuclear accident. This could happen anytime. The Russian ambassador is now warning that the U.S. resolution pushes for nuclear war over Ukraine. I mean, think about it. How will this war end? Are we going to accept defeat? And it's actually we're the one fighting. In reality, Ukraine is just a proxy. Will Russia accept defeat? Nobody's going to accept defeat here. So the only way to settle this is a nuclear strike. Somebody has to call the bluff. If the Russians do it, what are we going to do? In a warning to the West, Putin says Russian tactical nukes are being put in Belarus to stop a strategic defeat. In other words, they're going to use it. They're not going to accept defeat. So how do you think this one is going to be settled? That's another risk that could flare up out of the blue, and we could be back in a fundamental market. Technicals wouldn't matter anymore. Mechanics wouldn't matter. Mechanics would only amplify the moves to the downside. Then we have Europe and Britain. What kind of risks do we have there? We know that the ECB and the BOE are now raising rates aggressively. And they have to, because they're way behind the game. The ECB policy is rising significantly higher in a short amount of time, and it's still short of headline and core inflation. The problem becomes as rates go higher, and we've seen this happening here in the US, systemic risk increases. The chances of a systemic risk accident increases significantly higher. We don't know what that's going to be, but we have seen Credit Suisse. We have seen shares of douche banks collapsing before. Could be any bank. Could be any real estate company in Europe. Could be a big one. Could be a small one. We don't know. But all what we know is as rates go higher, the chances of an accident becomes highly likely. And the other risk, of course, as rates go higher, we start to see a slowdown in the European economy. We got PMIs on Friday, not looking good at all. And again, who's going to do the spending? Who's going to do the consumption in the economy? AI? Think about this one again. When it comes to Britain, of course, it is the epicenter of the crisis. And now that the BOE raised rates by 50 basis points and more to come, what do you think will happen to mortgages? Because they don't have fixed mortgages. They have to refinance these mortgages right now at a higher rate, and the rate keeps going higher and higher and higher. Well, somebody has to eat a bag here. Either it's going to be households, either they have to shut up and pay, which means their disposable income will decrease. Whatever they used to spend in the economy will now have to be spent on higher mortgages instead. Well, who's going to stimulate the economy? Or the British government could choose to let banks eat the bag and do mortgage restrictions, for example. At some point, the books of these banks will blow up. That is the kind of systemic risk that could happen right out of the blue. Pre-market, overnight, Dow gapping down by 1,000 points. We look at the wall of worry. We also have China. We know about Taiwan. This has been looming over for years now. Could it happen out of the blue all of a sudden? Sure, not a high probability, but it's something that we're aware of. And now they say that there is a new report saying that the US and China, not China, Taiwan, US and China are drifting toward war over Taiwan. That's a whole other enchilada, because you look at the tensions that we have with China right now, the chip war. We're now restricting chip exports to China. We're egging Japan to do the same. We're egging Europe to do the same, ASML. We're egging Korea to do the same, Australia. At some point, China has to respond. If we're tightening the noose against China, China will have to respond. And so far, we got the response of banning Micron. Okay, that's a small one. What if it is a big one? What if it is Apple? Chances are low for now, but that's another possibility. But of course, the most immediate risk that we have from the China front is the weakness in the Chinese economy. You see, if we go back to the beginning of the year, the thesis behind buying the stock market was not AI yet. It was actually China reopening. Wait till China reopens. We're going to see a recovery in the US stock market. Well, China been reopened, but the economy is doing miserably. We're not seeing the pace of economic activities improving. We're now talking about a double-dip recession in China. And of course, here's somebody who agrees with me. We now see a lost decade in China. Economic stagnation for years. Now think about China as an engine for the US economy. Lots of revenues coming from China. Lots of cheap labor. Improving margins. All of that is coming to an end. Okay, that's a fundamental case for the long run. But in the short run, when we talk about the fundamental risk, we could get a piece of economic data from China that is really, really bad. And the market reacts negatively. It goes down by a lot. Then you start to see these zero DTEs, puts this time around kicking in and producing a volume-getting-like move. Another element, and perhaps the most important one in the wall of worry, is the Federal Reserve, the monetary policy. It has been a mess as of late. And of course, right now, everybody's talking about why the pause, why the skip, if they're going to raise later. Jerome Powell was all over DC last week, and he kept saying, we're going to go higher, 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 higher for longer. Long way to go, he says. So why? Why the pause? Well, I got some news for you. We'll talk about it in details in a separate video, but it's chaos inside the Fed that led to the pause. It was not a tactical decision. It was not about the speed, as the bullshit by Jerome Powell says. Oh, it's about the speed. We're just lowering the speed of how we raise interest rates. Baloney. And with the yield curve inversion continuing to get deeper and deeper and deeper, the chances of a recession increases significantly higher. And the chances of a systemic risk event also increases significantly higher. That's the one that could come out of the blue, change the market from a technical market to a fundamental market, and exacerbate the sell-off. What used to be a pullback is now a sell-off. And then the mechanics kick in, short covering in the VIX, zero DTEs and puts start to kick in, the mechanics become really bearish, and the sell-off becomes a crash. We know that we have a huge number of corporate defaults happening right now, and rates are about to go higher and higher and higher until something blows up. If you think that there is another way that the Fed will end this monetary tightening cycle, you're a chump. And I got a bridge to sell you. They're not going to stop until something really bad happens. Of course, this really bad thing that's going to happen, it's going to happen out of the blue. Corporate defaults rose last month with 41 in the U.S. so far this year. That is more than double the same period last year. Companies are defaulting on their debt due to uncertain economic conditions and heavy debt loads. High interest rates have made it difficult to refinance, as debt is more expensive. The number of bankruptcy filings in the U.S. this year has also sharply risen to levels not seen since 2010. Are you listening or not? And of course, even Jerome Powell admitted that as they raise rates higher, we're going to start to see more problems in regional banks. He keeps saying, our banking system is safe and secure and sound and whatever. But he knows that regional banks are about to blow up. And soon enough, it's not going to be regional banks. It's going to be bigger banks. If rates are going higher for longer, it means they're going to wait for something to blow up and then they start cutting rates aggressively. And you're only going to hear about that something that just blew up after the fact. There's no invitation, there are no cards. Hey, by so-and-so date, X company is going to blow up. It doesn't happen that way. It comes out of the blue, and the shift to fundamental markets usually happens suddenly and out of the blue. So this week, when we got the note from JP Morgan analyst Marko Kolanovic, of all people, saying that the U.S. stock market is heading for a punishing sell-off as the unknown unknowns could drag market lower. People made fun of this note. Oh, Marko Kolanovic is desperate right now. Maybe he is. But when he talks about the unknown unknowns, this is what he's talking about. When interest rates across the globe are being raised dramatically at a rapid speed, the risk of systemic blow-up increases dramatically. And there is no invitation to that kind of risk. It just happens. And we are right now in the conditions. We have the same formulas that we had back in 2018 and 2020. It could be benign. It could be the 2020 case. Mechanical market, really impulsive. We get the climax, then the shift from a mechanical market to a technical market, and the NASDAQ goes down by 15%. But then it drags higher again. Or this pullback could be a 2018-like. It starts benign, but then the mechanical elements start to kick in and revert to becoming extremely bearish all of a sudden, and we see a volume-getting-like phenomenon. On top of that, we could see the market reverting all of a sudden to becoming a fundamental market. Look at where the 2-year yield is trading right now. Look at the 1-year yield. That one is trading higher than the level that blew up SVB and First Republic Bank. The federal funds rate is higher now. The ECB rate is now higher than when Credit Suisse collapsed. Enough said. Moving on to the market analysis, we begin with the closing of the market last Friday, and here we go. On Friday's closing, the Dow Industrial Average was down 219.28 points, or a decline of 0.65%. The Nasdaq down by 138.09 points, or a decline of 1.01%. The S&P also down by 33.56 points, or a decline of 0.77%. We look at the sectors all in all, down across the board, no positive activities at all, and the laggards, led by utilities, cyclicals, and real estate. When we contrast this with the weekly performance, what do we see here? All sectors are down, led by real estate, metals, and technology. And we see the outperformers, healthcare, and defensives. These happen to be risk off, not risk on, high dividend paying names. So despite all of the hype about a rotation, it did not happen this week. You see technology down big, but where is the rotation? If the money keeps going into cash and bonds, we're about to have a big problem here. When we look at the breadth, the NYSE 21% advancing versus 77% declining. The NASDAQ 30% advancing versus 67% declining. Awful breadth, but it is a little bit exaggerated to the downside, so my expectations are for a rebound at least in the pre-market session, just to go back to neutral, and then we see what happens. On to commodities, futures, look at this. The dollar was up on Friday by about 0.5 percentage point, and right away we see negative reactions across commodities. Although energy commodities held up a little better on Friday, although weekly declines for crude oil, Brent, WTI, gasoline, RBOB, heating oil, all down. The exception being natural gas, which managed to close higher by about 5% on Friday. We also got gains for the week when it comes to wheat futures, although with a pullback of about 1.25% on Friday. And of course, we see the weird phenomenon throughout the week as we see now correlation between the dollar and gold. The dollar goes down, gold goes down, dollar goes higher, gold goes up. Usually the two have an inverse relationship, but not this week. So we have a divergence here. Why are we seeing this? The answer is, I've heard a lot of explanations, but we'll know when we know. Perhaps this week, precious metals were just wired to follow bonds more than the dollar, and bonds were going higher for the most of the week, but they pulled down on Friday, and we see a recovery in gold, be it a small one. Moving on to the big casino, the options market, what do we see here? The volume is receding by a little bit, not in the big names though. What's really interesting is we see a little bit of more buying in puts. Not a lot, but we're seeing a little bit of buying. And this is how you can spot the change in momentum. We used to see calls in the 60s and 70s. Now we're back to the 50s in certain names. And we see a little bit of demand for puts. With that being said, Tesla at number one with about 3.5 million contracts traded on Friday alone. About 58% of those were calls. Amazon at number two with about 1.5 million contracts traded on Friday. About 73% of those were calls. So we have a little bit of a gamma squeeze going on in Amazon here, although it did not work out on Friday. Apple at number three with about 1 million contracts. About 56% of those were calls. We see a little bit of buying on AMD, buying calls. We got a bullish trade on AMD on Friday. Maybe has a little more juice to squeeze all the way to Monday. So we might see some rotations here as some gamma squeezes end in Nvidia and Tesla, and maybe new ones erupt in Amazon, AMD, Meta, or maybe they all go down together. If the market becomes technical and follows the Qs and the SPY's charts, they're all going to go down together. If the mechanical market continues, we will see a rotation from Tesla and Nvidia, the winners, into the laggards when it comes to options. But so far, from what we got this week, the market is indeed changing from a mechanical market into a technical market once again. Let's do some of the unusual activities that we got on Friday. We start with AVDL for Avadel Pharmaceuticals. The name is a winner for the year, but it did move down by more than 11% on Friday, and somebody's betting for more pain to come. They bought the 12.5 puts for the expiration date September 15th, with expectations that the name could go down and lose more than 7.5% of its value by then. They paid about $1.50 a piece. Tanner, this trade, all in all, spending about $1.5 million. And then we have the ticker SHEL for Shell. Somebody's buying the dip here. They bought the 65 calls for the expiration date September 15th, with expectations that the name will move higher and gain more than 9% by then. They paid about 70 cents a piece. Tanner, this trade, all in all, spending about $700,000. And then we have a put spread on the XOP, meaning energy. So you have one bullish trade on Shell. Here you have a bearish spread on the XOP. Somebody bought the 115 puts and they sold the 105, all for the expiration date July 21st, with expectations that the XOP will go down and lose more than 5.5% of its value by then, but not more than 14%. They paid about $1.40 a piece for the 115 puts. They received about 30 cents a piece from selling the 105 puts. All in all, the entry cost is $110. That would be per contract though. Per option, it's going to be $1.10 a piece. All in all, spending about $850,000. And then we have NWL for Newell. This is really interesting because the stock is beaten, bruised, and it's becoming oversold. Is it time for a rebound here? Maybe it is. And somebody bought the $9 calls for the expiration date August 18th, with expectations that the name will rebound and move higher by more than 14.5% by then. They paid about 35 cents a piece. Tanner, this trade, all in all, spending about $250,000. Last but not least, what about the ticker ZM for Zoom? Recently, we have seen a lot of call options buying on this name for whatever reason it is. And here we have another one. Somebody bought the 74 calls for the expiration date July 21st, with expectations that the name will move higher and gain more than 11% by then. They paid about $1 a piece. Tanner, this trade, all in all, spending about $600,000. What about the heat map? What do we see here on Friday? Down across the board for the most part, no rotation here at all. We see the big caps down. We see the gamma squeezers in Nvidia and Tesla down on Friday. Most of technology down big, so we see exodus out of technology. Although the exception being Meta, that has been dormant for a little while. Maybe it has a little more juice to squeeze. Everybody's talking about 300 now. We'll look at it in the charts analysis in a minute, but we also have a rebound in Adobe ADBE on Friday due to short covering, but all of these names appear to be toppy and they're due for a pullback. The higher they go, the bigger the pullback. But then you look at banks, financials, okay, we have Visa, MasterCard positive for the day, but the rest are down. You look at healthcare, mostly down. You look at industrials down, real estate, utilities, metals, energy, defensives, cyclicals, everything is down. So how can we have a soft landing in the economy or a new bull market when these sectors are not participating? Are we assuming that the consumer is going to buy a bunch of iPhones from Apple and we'll see more advertising in Meta and more buying of chips in Nvidia, more buying of cars from Tesla, but somehow nobody's going to consume more oil or more metals, more demand for industrials, consumer brands? Doesn't make sense. It appears that we have a bubble here, not a beginning of a bull market. We need to see the rotation to confirm that we are indeed in a bull market. Then we contrast this with the weekly heat map. Here it is. Red across the board. Even the big caps are kind of muted, with the exception being Meta, Amazon. These are the gainers for the week. Even Apple managed to close positive by a little bit, along with Tesla, despite the sell-off on Friday. What is the message here? We see managers, money managers, pulling out of technology, out of the AI mania, out of Microsoft, out of the software and chip names. But this outflow is being countered with inflow from the retail mom and pops, who are now buying Amazon, Meta, Apple, Nvidia, Tesla to a certain extent. So we have demand for dip buying. The question becomes, are they going to get dwarfed by more outflows from the professionals? That's question number one. But the most important question is, where will the professional money rotate to? So far this week, we have healthcare, big pharmaceutical companies doing okay, but not really. You have Merck, Sanofi, J&J, Eli Lilly. That's pretty much all there is. UNH, this is a rebound from a massive decline. So maybe somebody's buying healthcare here, but healthcare is defensive. It doesn't say good things about an expansionary theme coming to the stock market or any risk on. But all in all, you see all sectors are down for the most part. So the money coming out did not rotate to anything this week. Let's look at the ETF heat map for the week and see what's going on here. And the first thing we have to look at is fixed income. Had the TLT and the SHI and the SHV, IEF, all of these ETFs were lining up in the green, then it would have been a really ominous signal for the stock market that the money is rotating into bonds. But so far, the money's rotating into cash. It's waiting on the sidelines for a little bit. So there is still hope that we could see the rotation working out. But boy, look at the action this week. Small caps are down big. You look at Chinese ETFs, FXI, MCHI, all getting crushed. These are huge numbers to the downside. You look at the KRE, down almost 10% for the week. Regional banks, that is. Real estate down big. IYR down about 4%. Even retail, XRT, down about 3%. Technology down. Chips are down big. You only got the ITB working out, which is construction. Thank you to the spending on steroids by the Biden administration. But besides that, you only got natural gas working out. UNG, BOIL, massive gains for the week. But that's about it. And that should make you concerned about the stock market. What is the sustainability if we don't have a rotation? We'll keep an open mind. We'll look for it. But it did not happen this week. Let's do some charts and then wrap it up. We begin with SPY, the S&P 500, 30 minutes chart. What do we see here? We lost 433.79 twice on Friday on the opening gap and the closing bell. And there was an attempt to reclaim this level of support and close the gap above, but it was met with failure. So more likely than not, we should see a revisit to 430. And let's see if 430 provides some support in a reliable bounce, because this is a bearish move, not a bullish one. The fact that the SPY fails to close gaps and then closes at the lows of the day, technically speaking, these are not bullish moves. These are bearish moves. We'll look at the daily chart for the continuous contract for the S&P. What do we see here? All in all, believe it or not, nothing happened this week. We traded within a range. Support still 43.84.5. Resistance still at 44.72. Nothing changed at all. Now, I've been cautioning the bears that all what we have right now is a market transitioning from a mechanical market to a technical market. That's all there is. So we are expecting a pullback. Now, if we start to see losses of important supports, if we start to see the mechanics shifting toward becoming bearish, extremely bearish, not just neutral, huge put orders showing up, if the fundamentals start to matter all of a sudden, then we could see a massive flush down. But for now, the upside risk is, what if this is an ABC pattern? And higher we go. We finish with a B leg, a retest of the support, and then the C leg takes us higher. That is entirely possible. The downside risk is, if we look at the RSI in negative divergence, the MACD is losing momentum. And if everything works according to plan, we see a pullback to closing the gap, and that would be a downside of about 2% or so. And then the RSIs will become a little oversold, and we'll take it from there. We look at the SPX, the cash index, a weekly chart. What do we see here? Closing within the channel. Is it a reversal candle? The answer is no, but it is a negative closing. the first in about 5 weeks now. And when we look at the monthly chart, what do we see here? No confirmation yet. If you look at the MACD indicator, no confirmation yet. We have a few days left for the month, but no confirmation. And if it starts to get ugly here, we start to lose the potential for a bullish confirmation. Watch out. It could say that this is the top in the AI mania. And down we go. We'll look at the Qs, 30 minutes chart. What do we see here? We got a gap down on Friday. It managed to reclaim 464.11 as support for a little while at least. It closed the gap, but then it made a U-turn and it closed below 364.11. That's the bearish element of the close. Yet the bullish element of the close is it did close above the lows and above a previous gap. Most importantly, above 360.42. So minimal damage here for the Qs. We look at the daily chart for the continuous contract. Nothing happened. Support still at 15,000. Resistance at 15,500. And of course, we know what the upside risk is. ABC pattern. We have consolidation, retagging support at 15,000 and higher we go. Yet the downside risk has the better case because it is supported by the momentum indicators. RSI in negative divergence. MACD losing momentum. And the bearish outlook says now that we have a reversion to a technical market, we have to go down to closing the gap and maybe retagging the support line. And that would be a downside of about 4% or so. And then we'll see what happens. Could we see a rebound from 14,445, for example? And then the rebound fails, forming a head and shoulder formation? We'll see. We'll take it one step at a time. But for now, what we're looking for is closing the gap. And at that time, the RSIs, the MACDs, will be closer to average. And then we'll see if any mechanical elements are about to kick in or the fundamentals are about to matter. If that is the case, we're going to go all the way back to oversold, and a pullback of 4% could become even bigger. We'll look at the NDX, the big NASDAQ, a weekly chart. What do we see here? We have an important trend line, acted as support before. Now it is acting as resistance. So we see the NDX, as you can see in the RSI, is overbought and due for a pullback. And the symmetry around the line is really important. We have positive divergence that lasted for a little while. We have a negative divergence that lasted throughout 22 and 23, but now we're back to the same line. So what happens here? The bulls have to climb above the line to prove that this is indeed a bull market. It fought and it won. If they fail here, then all what we've done is just fix the symmetry, fix some of the oversold conditions, aided with the AI mania, and then we resume what we began in 22. And down we go. Look at it from a monthly chart perspective. Here it is. You can see the symmetry. It's amazing. But then you look at the MACD and we have a positive confirmation. But we have a few days left for the month. If the NASDAQ loses the gains month to date, then boy, we got a problem. This could be the top right here. And of course, the bearish outlook is we see an ABC pattern all the way to the big trend line. And that would be a reversion to the mean. And here's the Dow Jones, just to present the bullish case for the rotation. The Dow Jones, if you look at it from a weekly chart perspective, it has been in, let's say, a reverse head and shoulder formation right now. If it does play out, it will play out because we have a rotation into the blue chips, dividend-paying names, cyclical kind of names. If we look at the Dow Jones from a monthly perspective, again, you could argue that this is a bull flag pattern, and higher we go. So this is the bullish case, and it depends on a rotation. Now, if we see the NASDAQ failing to climb the trend line, then we see the Dow Jones losing these bullish patterns of a reverse head and shoulder and a bull flag on the monthly, then it'll be a confirmation that this was an AI hype just to fix the oversold conditions and the extreme bearishness in the market, and that's all there is. And then down we go to resuming where we started back in 22. And you're going to see it happening beforehand. You'll spot it before it happens. You'll look at these patterns and say, okay, this is not playing out. The NASDAQ is getting rejected from the trend line. The Dow Jones is failing the reverse head and shoulder pattern. The bull flag on the monthly on the Dow Jones is melting down. You gotta start to see it before it happens, and you can bet on it, of course. IWM, the rotation poster boy, what happened here on the hourly chart, not looking so good. It couldn't climb 182 again. Is it oversold? The answer is yes. So could we see a rebound and a retest to 182? Sure. But will it hold? Because if it does fail, and down we go to 179.10, forget about a rotation. We're gonna start to talk about, oh my God, what's going on here? AI mania being sold, no rotation to the IWM, and the bears will start to gain momentum out of the hands of the bulls. We look at the IWM weekly chart. What do we see here? We've been in consolidation for almost a year now, and this weekly candle doesn't look pretty good. It looks like we We just got an oversold bounce in the IWM and industrials and metals and oil and dividend-paying names. But these oversold bounces are coming to an end now, and there is no rotation. If we do break this consolidation range to the downside, then the move should be, you take the move above and you plug it to the downside. That would be a break from the consolidation range of about 27%. So that's a crash. Therefore, you have to watch this chart like a hawk. If it continues to trend down, we got a problem. And this is why the rotation is really important. You cannot rally without the IWM. If it breaks the consolidation range to the downside, then we have a crash coming of about 30% or so. And that's not a bull market. Look at the Dixie 4 hours chart. What do we see here? We got the double bottom pop out of 102. Now, if you happen to be a bear, you want to see the dollar going higher because that's your confirmation that the equities market will go down. And of course, you want to see the VIX rebounding higher. That would be another confirmation. Of course, the rise of the Dixie on Friday confirms that the outflows out of AI and technology is now chasing cash, at least for now. We see the dollar appreciating on Friday. If it continues to move higher, we got a problem, folks. You look at gold, if the dollar breaks 103, you got to go short gold because we have a pullback all the way down to, let's say, 1800. Otherwise, stay patient here. When we look at the weekly chart for gold, it appears that we have a triple top, losing momentum on the hour side, the MACD. You put it all together. If the dollar breaks 103, you have to go short gold all the way to 1800. And the same goes for the SLV. Look at this silver. It has been in a bullish range, bullish channel. But is it out of the ordinary to say that SLV has to go down in a revisit to the lower end of the channel? The answer is absolutely not. And if the dollar spikes higher, if yields stay higher, we will see the SLV going down. Here's UK oil, Brent oil. What do we see here? Now we have, the fifth rebound. At some point, oil got to put up or shut up. Either you're going to close above 77 comfortably for the week. Otherwise, this has been torture for oil investors because you go to the weekend not knowing what's going to happen. If we have a close above 77, above 80, then at least you got a cushion. And if there's any bad news over the weekend, you got enough time to get out because of the cushion. But when you close like this, if you get any kind of bad news and we see oil crashing overnight, there is no time to get out. And this is why oil investors, it's been tough. But now what we've seen in Russia over the weekend, this is pushing oil prices higher. And this, of course, comes on top of the supply cuts by Saudi Arabia. So we could see short covering getting triggered in oil. And we know that oil is heavily shorted. The problem is China. If the China demand problem is not resolved, oil is going to be a tough trade this year. If China recovers, then we will see a huge short covering rally in oil. So the dynamics are all over the place here. We look at natural gas, the Henry Hub weekly chart. What do we see here? We have a saucer bottoming formation, which means we have an explosive move coming for natural gas. Once it passes 3, we're going to start to see massive short covering. In other words, we could see natural gas reaching all the way to 4.7 at some point. That is a huge move. And of course, I always say invest in natural gas stocks. When you trade UNG or BOIL, you rent, you don't buy. Is it the time to rent BOIL? It's been moving massively, about 50% since the bottom. You look at the chart, it is showing, the hourly chart that is, it is showing a cup and handle formation. So we know there is a massive move coming. You can rent BOIL, you buy calls on it if you want, but make sure that you close quickly. And you're going to rotate all of these gains to something more stable, such as natural gas stocks. Then we'll look at the 2-year yield, the daily chart. What do we see here? It's getting to a dangerous territory now. The blow-up of SVB happened when the 2-year was trading at 5%. We're now at 4.748. So we're getting closer. But I do have a hunch, I don't know why, that we're going to see a big flush down on the 2-year yield. You look at the 1 year. This is a weekly chart. You look at this chart and say, okay, this is consolidating in a bull flag pattern, and higher we go. Sure, Jerome Powell says higher for longer. But I told you repeatedly in this channel, it's higher for longer until something breaks. You look at this chart, and you can see it, that there is the potential for a big flush down candle coming. Now, why would that happen? The chairman of the Fed says we're not going to do rate cuts anytime soon. The chairman of the Fed says higher for longer. The only way this chart's going to flush down is if a systemic risk accident happens. This is what I mean when we talk about the unknown unknowns. When we talk about Volmageddon, we have the conditions for that happening. As far as the timing, that's up for grabs. I'm not Nostradamus over here. But do we have the conditions for a phenomenon like Volmageddon to happen again? The answer is absolutely yes. You look at the TLT weekly chart, what do we see here? It did break trend. But look at the momentum indicators, the RSI and the MACD. They're being fixed right now, so we could see a bullish break. You look at the monthly chart and the TLT, look at this. It's going to happen at some point, folks. Just a matter of time. The RSI already bottomed. The MACD did the same. So we know there is a huge demand coming for bonds. The TLT will move higher again. Why would that happen? Exodus from equities, chasing bonds. Put 2 and 2 together. You guys are big boys and big girls, so I don't have to spit it out for you. VIX, 4 hours chart, what do we see here? A change for once. Instead of the VIX gapping and cramping per usual, we see the VIX actually closing positive. We have a positive divergence on the RSI. We have a positive crossing in the MACD indicator. What does that mean? Sooner or later, we have a big pop coming in the VIX. And I know a lot of you crybabies keep telling me, oh, the VIX is broken, Maverick. Just leave it alone. Okay, you leave it alone, bitch. I'm going to do what I see fit. And what I see fit is going long volatility right now. When we look at Apple, a daily chart for the big kahuna, what do we see here? It is trading within a narrow channel. Up and down, up and down, up and down, but it is bullish. There's no problem here at all. We look at the weekly chart. What do we see? It is a steep and narrow rally. Kind of looks similar to the rally from last summer. Just saying. Kind of looks like any rally, the mechanical rally that came to an end. It's just a bigger one right now. Then we look at the sloping line of support now. We're far away from this line, but you look at the RSI, it's really overbought. The break from this wedge pattern is going to happen in a flush down, and the flush down would take us all the way down to 169.69. That's an important number, but could it be exacerbated? We see Apple revisiting this sloping line of support. That is entirely possible. We look at Tesla, an hourly chart. What do we see here? Still holding the support line for now. The confirmation that the gamma squeeze is over would be losing 249.16 as support by the end of the day, and that would lead us to closing the gap at 234.86. We look at the daily chart for Tesla. What do we see here? The pullbacks are coming at higher volume. We have a bearish engulfing candle. So we have a confirmation for the top, but we need to see a loss of 249.16. The RSI is weakening. The MACD indicator is moving down. So we know that the reversion to the mean will be violent. Now we could see Tesla back at 200 in no time, especially if we see a reversal, a technical reversal, because this is what it is right now. The RSI is way too elevated, so it's just going down to neutral. And that should be a pullback all the way to closing the gap at 234.86. But if we have mechanical elements becoming bearish all of a sudden, aka a reverse gamma, then the RSI will have to become oversold. And that could be a pullback all the way down to 200. So again, when a lot of you say, when are you going to deploy a big trade? Let's say with $1 million plus, shorting whatever. If it's a plain vanilla pullback, why would you deploy that kind of money for? If it's just a technical pullback, if we move from a mechanical market to a technical market, then that's not really worth a big short trade because you're just playing a pullback. You stick to put options, small bets, not big ones. But if we start to see the mechanical elements moving quickly to becoming bearish because of all of this shorting of the VIX and zero DTEs, gotta watch those. And then perhaps you see a fundamental front starting to flare up. Then you got the ingredients of a big reverse gamma, a big flush down, and then you deploy those kind of trades. NVIDIA, hourly chart, what do we see here? So far, keeping 420 as support, although it's kind of stalling here. If we clean up the chart a little bit, we have a rolling top pattern. The confirmation would be breaking 420 as support. If that happens, we're still looking for a pullback to closing the gap at 395.65. Then let's look at weekly charts for big cap technology names and see where the RSIs are looking like. Amazon, getting close, 129, got to the target, RSI becoming really overbought now. So we have a check mark on Amazon. Doesn't mean that's going to stop right now. It could move, actually, I told you in the live stream on Friday, some of you at least, that we could see a move in the extreme case all the way to 138.60. But we're getting within this zone where, okay, we have more names now, not just the index. We have more names also joining and becoming really overbought. We'll look at Google, what's going on here, not really overbought on the weekly chart, but it is stalling. But you can't make a bet against the name right now because we don't have a confirmation. The confirmation would be if Alphabet loses 117 as support. Not every chart has to become way overbought before it pulls back. It could pull back from here, but you need to see the confirmation that 117.11 is lost as support. We'll look at Meta. It is overbought in the RSI, but it keeps going on. So we have 300, the psychological target right now. That's the max. And then we have the reversion to the mean, which is 224.20. And again, the higher the chart goes, the bigger the pullback and the more realistic 224.20 becomes. Microsoft, we got the double top here. No confirmation though, just a pullback for the week. Although the RSI is getting weaker, it is in the overbought territory, so we have a check mark here. And last but not least, we look at Bitcoin. What do we see? It got to 31,000. Could it go higher? The The answer is yes. But will it go higher? The answer is probably not. The RSI is way overbought right now, and the dollar that was going down throughout the week popped higher on Friday. So at this point, I would say the majority of the juice in this move in Bitcoin has already been made. And you're kind of chasing right now if you're buying. And if you know me, I'm not a monkey. I don't like to chase. Either you caught it on the way down when we talked about it in this channel. And most of you did not believe it, by the way. Oh, Maverick is becoming bullish Bitcoin. It's time to sell. Yeah, right. Anyways, moving on to the conclusion of this video, what do we have on the economic calendar this week? Tuesday, the 27th, we have durable goods, we have the home chiller index, we have new home sales and consumer confidence. Wednesday, the 28th, we have retail inventories, wholesale inventories, and we have Chairman Powell. Here we go again. Thursday, June 29th, the big dog speaks again. Is he going to grow a pair? Absolutely not. So what is the point of even listening to him talking if he's not in charge? If the handlers are in charge. Anyhow, we also have initial jobless claims and pending home sales. Friday the 30th, most important day, we have the PCE inflation rate, personal income, personal spending, Chicago Business Barometer, and the final reading of consumer sentiment. And with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Well, look, what we got here is a risk versus reward kind of thing now, Fitzy. We already took the risk. And yeah, up till now, it's not been working out so well, I know.
Yeah, but